Please note that this podcast was recorded before ATAF released their technical paper on Pillar 1 Amount B. Accordingly, no mention of that technical paper or its contents have been included in this podcast.
Good day, everybody, and welcome to the next scintillating episode of TP Matters, our transfer pricing podcast. My name is Michael Backer. I'm a transfer pricing partner at PwC, and I've got an esteemed panel with me today. I've got Osman Malaji, my fellow TP leader. I've got Cornelia Espost, Archie Romano, the two directors, and Anita Wadani, the experienced senior manager. Right, so what are we talking about today? We are talking about another pillar and another amount. So we've got Pillar 1 Amount B. And that's got to do something to do with sales and marketing and distribution and streamlining it. When the world says we're going to make tax simpler, I always get nervous because inevitably it gets more complex. Cornelia, do you want to tell me a little bit about what is Pillar 1 Amount B and why was it introduced? Paint the scene for us.
Thank you, Michael. So Amount B of Pillar 1 is one of the two components of the OECD's proposal to address the tax challenges arising from the digitalization of the economy. The other component is Amount A, that allocates a portion of the residual profit of multinational enterprises to market jurisdictions based on a formula. We are, however, not going to be discussing that part today. Rather, we're going to focus on Amount B. So Amount B aims to simplify and streamline the transfer pricing rules for certain baseline sales, marketing and distribution activities by providing a fixed return. And we'll discuss how that's computed a little bit later. The return is based on the functions performed, assets used, and risk assumed by the distributors. And also, as I mentioned, that fixed return, there's some benchmarking that's been performed by the OECD. So the OECD's intention behind Amount B is ideally to reduce the administrative burden and compliance costs for both taxpayers and tax administrations and to enhance tax certainty and consistency across jurisdictions. Ultimately, whether this will really be achieved is not yet certain, and during this podcast, we'll discuss some pitfalls and challenges around the interpretation of these new rules with our listeners.
Okay, so we've got a distribution entity in country, and the idea is to make it simpler to look at the TP for that distribution entity. Lovely theory. Let's see how the practice plays out. What activities and transactions are actually in scope? So how do I know if I'm in Amount B or not?
Great, thanks, Michael. So the scope of Amount B is limited to wholesale distribution of tangible goods. And the scope specifically excludes those entities involved with the distribution of commodities, digital goods, or undertaking significant non-distribution activities. Then in the OECD report, they set out the characteristics of what an in-scope distributor would look like, which, for example, would not own unique and valuable intangibles. The following controlled transactions are qualifying transactions for the simplified and streamlined approach. It's essentially buy-sell marketing and distribution transactions where the distributor purchases goods from one or more associated enterprises for wholesale distribution to unrelated parties, and also sales agency and commissionaire transactions, in that case where the sales agent or the commissionaire acts on behalf of one or more associated enterprises to conclude contracts with unrelated parties. So a mouthful, but in essence, it's limited to, I'm going to call it simpler type distributors. As soon as you cross certain thresholds, then you will no longer fall within this guidance.
Okay, that's interesting. So where all of this started, if you recall, was the fight with digital services taxes and the French and that with the Americans, and then the Americans wanting to tax French wine and cheese, all because of Google and Facebook and these big American IT companies which weren't paying enough tax. So the French said in their country. And this was all, that started the whole ball rolling. But actually now the answer has come out and they're totally ignoring all of that. And they've gone to much simpler, more physical distribution activities. Okay, so the whole cause of the fuss has been ignored and we're somewhere else. Okay, fine. So that's where we are. Anita, maybe talk to me, how does this pricing mechanism work?
Thanks, Michael. Like you said, this is a simplified and streamlined approach. It's actually not. So if you just go into the details of how the mechanism works, it can actually get very complex. And I will try to simplify this in, the steps that OECD is suggesting. So the first one is just to understand what your industry is. So do you fall into consumer goods? Do you fall into industrial goods, medical goods, etc.? So these are the definitions that are provided in the definition sections itself. So you look at the industry grouping, is it 1, 2, or 3, and then you decide where you fit in. Then the next step is to understand the factor intensity. The factor intensity, you mainly need 2 inputs for this, which is your average operating assets and your operating expenses as well. So what this helps you to do is calculate the operating assets and operating expenses and see where you fit into the industry grouping, which will ultimately give you what your return on sales should be. Then to make it further complicated, OECD basically introduced the cap and collar approach, which is basically looking at the operating expenses and operating assets once again. And there are certain limitations or thresholds that are provided in the cap and collar approach, and you need to follow that with your data inputs to understand what thresholds are applicable to you. So those are the guardrails that are applicable. And the third one is really interesting, where the OECD wants the qualifying jurisdictions to make adjustments based on the country risk premiums. So this actually gets a little complicated, and the country risk premiums are predefined in the OECD guidelines itself. So, I mean, there is some leeway here where you can actually look at your net risk adjustment, determine that, and then based on that, you need to apply your country risk or a country risk premium. But like I said, this is really complex, and it's not exactly streamlined or simplified. Yeah, so I mean, I would say that if you follow the steps, you probably might get to the answer. But then if you do have a lot of industry groupings, let's say in one company itself, it can actually get really complex, like which grouping should you apply? And the last step, which is country risk adjustment, is actually suggesting to make changes to your cost of goods sold, which can actually trigger a lot of issues such as, customs, indirect tax, etc. So, yeah, the taxpayers have to carefully follow this approach to understand how this is applicable to them.
Okay. Do you have an idea of how the OECD arrived at the returns they're sort of saying are appropriate? Presumably it wasn't just thumbs up, there's some science behind it. Give us a flavor of what their thinking was, if you know it.
Yeah, I think they just spoke to a bunch of Big Four or transfer pricing experts to just understand how the benchmarking is performed. So one of the sections or appendices in the guidelines actually provides a very concise benchmarking strategy. I mean, if I was performing the benchmarking, probably I would use some of the steps. So it's not way off, but the only thing is that they have used global sets, and they have completely ignored the nuances of transfer pricing in terms of the strict comparability that we need in terms of determining the return of the distributors.
Yeah, because they're trying to do a broad brushstrokes, one size fits all, which means you can't get too nuanced. Okay, so we've got the simplified approach. We've seen who can sort of potentially apply for it, the types of activities. Archie, talk to me a little bit about when does this apply and which jurisdictions can apply. So we talked about the type of work that the distributor must do, but now let's look at where, in what jurisdictions can this be applied.
Sure, Michael. Thanks for that. This simplified, streamlined approach is an elective framework with a particular focus on the needs of the low capacity jurisdiction, who are now referred to as the qualifying or the covered jurisdiction. So the intention at the heart of this approach was the low capacity jurisdictions would not have critical mass in their revenue authority offices to carry out enough and meaningful assessments on the different taxpayers. So this streamlined and simplified approach was a mechanism to give a framework so that those low capacity jurisdictions or low to medium capacity jurisdiction can carry out assessments.
Okay,
So now,
you've got, let me just make sure I understand this. So we've got a list of countries, typically poorer countries, where they don't have the depth of expertise in their revenue authorities. They then can say, right, I can't apply all of this very complex TP because it chews up too much in terms of resources, which we don't have. So for us, we can apply a simpler approach. Is that sort of the theory behind it?
yes, that's the theory. And the way this approach will work in practice, that the jurisdiction, let's say South Africa, can make an election, and that choice on election will be either binding on all the taxpayers of South Africa or of that jurisdiction, or it could be a taxpayer specific elected safe harbor. Now, it is very important for the reader to note that the transfer pricing outcome under this approach by the adopting jurisdiction will not be binding on the counterpart jurisdiction if that counterpart jurisdiction has not opted into this approach. So just an example. So let's say South Africa chooses to adopt this approach, which by the way, they have said they will. And let's say USA has not adopted this approach. So the transfer pricing outcome that will be applied by SARS in this case for any particular taxpayer in South Africa will not necessarily be binding on the IRS of the USA.
Okay, so how then are the qualifying and covered jurisdictions defined and listed? You've got a number of lists. Just talk to me a little bit about those.
Yeah, there are a couple of lists here, and the report kind of articulates the manner in which OECD came up with this different list. So they come up with 3 lists of jurisdictions. And now the way they have attempted to bifurcate them is the first list of jurisdictions which will apply a specific cap related to operating expense cross-check. Now, which is a safeguard for the results determined under amount B. The criteria by OECD for determining the list of qualifying jurisdictions for this list was based on a World Bank Group's country classification by income level and the availability of transfer pricing data. So that's the first list. The second list is the list of the covered jurisdictions, which are low and medium income jurisdictions. That's where South Africa also falls, by the way, that have expressed their willingness to apply amount B and have committed to have a political agreement on amount B. So that's list number 2. And the third list is the list of jurisdictions that will apply the data availability mechanism, or in a manner which will also apply a country risk adjustments for qualifying jurisdictions that lack sufficient data points in the global set. So you can imagine the third list is the list of the countries where the data or information is not so clear.
Okay, so we've got these lists. You've got a list of low capacity companies, the poorer countries. They potentially could fall within this if they sort of elect to do so. You've got another list of people who say, yes, I will abide by this, and give them the lower one, the lower sort of, well, the higher rates actually. You give them the benefit. Not many people seem to have signed up for that of the major exporters. So we'll get onto that a little bit later to see how that then works. What are the documentation and dispute resolution implications?
Yeah, and there are a couple of them, Michael. First of all, the guidance says that the taxpayer should have enough documentation to demonstrate the eligibility of their business to Amount B. So, like Cornelia explained just now to us, that there are specific criteria on how or who shall form into this Amount B. So, first you need to qualify and have documentation to support that you form within the realm of Amount B. So that's one. And once you have that approach, once you fall into it, the report expects you to also have documents to support your profitability and how do you align to Amount B. So that's one. But again, an important note to the readers or the listeners is that the guys or the taxpayers who do not fall under Amount B, that does not mean they don't need to have documents prepared. They will have to have documents to support their existing transfer pricing requirements as per the local countries or wherever they operate. So that's another reminder. Also, Amount B does not preclude any possible audits or adjustments by the tax administrations that either the taxpayers or tax office can use to move forward the existing disputes or mutual agreement process or advanced pricing agreements, as called as APAs, to resolve their Amount B disputes. So you can imagine it's a two-way approach. Have some documents, but it's not be all and end all.
Okay, so that gives us a bit of a flavor of those practicalities. I alluded a little bit earlier to, yeah, how's it going to work in practice? So, I mean, in essence, and I'm grossly oversimplifying, and South Africa is a bit of an interesting case, which you'll get to later, but by and large, you've got the rich capital-intensive, countries who've got deep pockets. They create stuff, they sell it through distributors. Some of those distributors are situated in poorer countries. Those are mainly the low-capacity jurisdictions. But it seems to me if everybody doesn't play nicely with each other, this is fairly pointless, because if both parties don't sign up, well then, so what? Osman, maybe you can sort of unpack this for us. What are the main challenges and uncertainties that may arise from Amount B?
Thanks, Michael. I think you probably just touched on the main one, but I'm probably just going to be summarizing and touching on some of the things that Cornelia and Anita and Archie already covered. But the first one really is optional adoption. And the question, and just stating what you said already, is that does that really change where we are today in the following respect, that you will still have, or what optional adoption means is that you can have different adoption on different sides of the transaction. So one country adopts it, the other country doesn't. Do you have any difference in the dispute and the position that you have, the risk of double taxation or one-sided adjustments that we have today? So that's one of the challenges that optional adoption still leaves us with. The second point is they're still, as broad as the covered items are, it's still limited to only the wholesale distribution of tangible goods. So it doesn't include services, digital or otherwise, etc. So it doesn't cover that. So it leaves that it leaves that still slightly unresolved. And it doesn't really cover the diversity, the full diversity of business models. So that is likely to create complication when you have slightly more diverse models. Probably the last point that I want to make is, as you'd expect, is that you have a little bit of a one-size-fits-all attempt here, and that's just, I suppose, the reality of the way Amount B rules have been written. So both in relation to the pricing mechanism and the fact that it relies on a global data set and regional and country risk adjustments. The question obviously will be, does it cover everything? If we've got a one-size-fits-all, it's not necessarily going to be localized for the full range of factors that impact profitability. And the second thing also resulting from this one-size-fits-all is that we've got a little bit of vagueness, uncertainty, lack of detail around documentation and evidence, the granular detail of what will be required in country in various jurisdictions.
Okay, so I think it's quite interesting. So obviously the one-size-fits-all sort of issue, that's inherent in trying to simplify things. So I think that sort of makes sense to me. What I'm grappling with is we're saying you've got the richer capital-rich countries who are exporting. If they sign up for this and they're exporting to a low-capacity poorer country, if they sign up for this, by and large, it looks like the poorer country is going to be better off. So the richer country is giving something away. So, they may very well not sign up for this. And in fact, the list of countries who said, yes, we will play ball with this seems to be quite thin. So South Africa is in an interesting position because we are on the list of low capacity jurisdictions. So to the extent that we are importing stuff, by and large, our trade metrics are that we're importing it from the non-low capacity jurisdictions. And then if they don't play ball, this doesn't help us at all. However, South Africa also in its area is an exporter. So we're an interesting country in that we sit in the middle. Relative to some people, we're the poorer importer, relative to others, we're the richer exporter. On those exporting, we're in, it sounds to me, just unpack that a little bit for me. How does South Africa play in this whole thing?
So it's not really clear, Michael, and I want to repeat one of the points that Archie said earlier, is that the first thing to keep in mind is that we haven't really had confirmation or commitment from SA as to which model they're going for. And I'm referring here to the points that were made earlier on about us having the option to either go for a binding arrangement where in terms of law, it'll be applicable to all distributors in SA, or whether it's going to be an elective position, safe harbor. So if I can maybe just think about the scenario where it's elective, and I want to talk specifically about SA outbound. So if it's elective in a different country, we've kind of committed in SA that we will respect that. So you'll have an adjustment where our foreign distributor is, and do we adjust, essentially take a lower taxable income in SA? More than likely. So that's that doesn't necessarily count in SA's favor, and I'm talking about now from the perspective of the SARS and National Treasury, but it also creates complications for SA-based multinationals. For inbounds, again, depending on whether we are elective or not. If we are elective, so inbounds will simply, by and large, not apply it unless they expect the foreign parent, wherever the multinational is situated, wherever they are headquartered, unless they expect them to also implement it. So our fates here in SA are kind of tied to which model we adopt. And you are absolutely right, Michael, that it's going to be quite, and we're going to have to model probably and make judgment calls based on when we see the rules on which is the most appropriate position to adopt from either an SA-based multinational or an inbound multinational. We will have to weigh that up, and you're gonna have different answers. And obviously, that then means, and just maybe to end up, it does mean that we need to consider the Amount B rules together with other mechanisms that might engender greater certainty, like APAs and MAPs when they are applicable.
Okay, so in essence, if I try and understand this, it sounds to me like the devil's in the detail. It depends on what SARS comes through with how it's going to be implemented. There is a risk that South Africa, by being on both lists, but also being an exporter, could be worse off, because where we import, we may not get the higher amount because the person who sells to us isn't going with the simplified approach. But we export to the rest of Africa, we potentially are going with the simplified approach, which means we give away. So politically, I understand that and why we're going with that approach, but from a pure tax revenue point of view, I'm not sure that it makes total sense for South Africa, but let's see how things develop. Okay, any concluding comments from anybody?
I think it's just going to be interesting to see how this ultimately plays out, especially whether we go for the binding approach or whether it's elective. I think that also impacts the comments that you've just made in terms of where SA will ultimately end up.
Yep, and I think that one thing we can conclude is that although it's a simplified approach, it's not going to be simpler for taxpayers.
I don't know, Michael. I think maybe for the simpler scenarios, and I'm using the word simpler again, I think there will be, again, coming back to the point that you made earlier on about let's do the homework. I think there will be some scenarios where we will find that it actually is simpler to adopt this and to apply it, and life will be simpler for those multinationals. For others, I mean, I don't know if things are going to be worse than what they are now. My view is that it's going to be a matter of, well, things are complex already, and our Amount B didn't help us. I think that's probably going to be the other side of the story.
Okay, so if you're a distributor or using distributors, bear all of this in mind, and we'll keep you abreast of what happens. And that's all, folks. Thanks very much for listening. All rights reserved. PwC refers to the South African member firm or one of its subsidiaries or affiliates, and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes and should not be used as a substitute for consultation with professional advisors.